Our friend John is in the fortunate position of being a high net worth individual, and he regards the US dollar as his base currency. Now, he does have investments in various bonds and stocks and so on, some of which are not denominated in dollars. Now, this means they pay coupons and dividends in foreign currencies, which, when you swap them back to dollars, may move up and down in value purely because of exchange rate changes. So there's a real impact on John's cash flows here, and these changes in value are what we call transaction risk. Now, John also owns properties in different countries, and some of these are financed with mortgages, in other words, loans secured on these properties. Now, the payments he makes on these loans also move up and down in dollar terms. Again, this is transaction risk. So you can see that transaction risk is when physical cash flows are involved, and risks like this can be managed with foreign exchange instruments like forward contracts and currency options. Well, let's take a look at John's properties. Imagine he bought property in the UK for £20 million. Now, when he restates these properties back into dollars, for accounting purposes, at the prevailing exchange rate of 150, they have a dollar value in his books of $30 million. Okay, over the course of the year, let's imagine that sterling falls in value and the exchange rate moves to 130. In other words, a pound used to get you $1.50, now it only gets you $1.30. Well, this means that in dollar terms, the value of his property has fallen from $30 million to $26 million, a drop in value of $4 million. Now, has John lost real cash? No, he only loses cash if he actually sells the property. So what he's got here is just what we call a paper loss. No actual cash flow was involved. Okay, let's look at another example. This time John's going to buy some property in India. Now, in India, interest rates are a lot higher, and if he takes a rupee, an Indian rupee denominated loan, it would cost 10% in interest, way above dollar interest rates. So if he had a 600 million rupee loan, this would equate to about 60 million rupees in interest cost. So John says, forget it. What I'm going to do is take out a dollar loan. Now let's say that 600 million rupees is the same as $10 million. So we're using a dollar rupee rate of 60 rupees to the dollar. And let's assume that dollar interest rates are 2.25%. Well, based on this exchange rate, John's interest expense would now only be equivalent to 13.5 million rupees. So this is way below the rupee loan interest expense of 60 million. Now, where does the 13.5 million come from? Well, just imagine you had 2.25% on 600 million rupees. That's because you can see here dollar rates are about a quarter of what Indian interest rates are. Now, even if the rupee exchange rate versus the dollar drops from 60 to 70, John's interest cost is still only 15.75 million rupees, way below the cost of a rupee loan. However, the loan principal could increase in size, and it could go from 600 million to 700 million if the rupee depreciates. In other words, if the dollar has appreciated. So very much principal at risk, and you have to be very careful. Don't be tempted to take on foreign currency loans unless you have income in that foreign currency, because often it can be the translation risk and the transaction risk which can really affect you. So to summarize, transaction risk involves real cash flow movements, while translation risk is only a gain or loss on paper.